thousand for, oh my gosh. Boy, not only was I wrong, down 0.9% on first look at second quarter GDP, down 0.9%. Okay, I know there's an organization that decides whether we're in a recession or not, but investors, they're not going to wait. 2 back-to-back negative quarters, it's not good. Call it whatever you want. Consumption up 1%, that's a bit light. Sequentially, that follows 1.
Call it whatever you want. It seems like officially the US is in a recession. So that's what we're getting. Are you telling me to put my volume up? All right, let me put my volume up. More. How's that? Can you guys hear me? All right, call it whatever you want, but it now seems that the USA is in a recession, or at least by the dictionary definition of a recession, the US is now in a recession. But what does that actually mean? And if the US is in a recession, then why are Bitcoin and the crypto markets not actually moving? Because you got Bitcoin at 23,000, and that's where it's been since Powell spoke. So today we're going to speak to a macroeconomist about recessions. We're going to talk about when you should be buying in a recession and how bad this recession could actually be. We're also going to be looking at Powell's speech last night and show you guys why the markets are going to run and why it may actually be risk on, or at least it's going to be risk on for the next couple of weeks or months until September. All right, so let's do this. I told you, I don't care what Fred thinks. I'm going to carry on playing the song. I need you guys to do me a favor. I'm trying a new microphone out today. I need to know from you whether the microphone is loud enough, clear enough, whether it sounds good, or whether I should go back to the old mic. So tell us in the comments what you think. I'm going to check the comments now. I see you guys all in the comments. I see Luke's Snipe. I see you, Joby. I see you. I see Jake. I see Elizabeth. I see Jacqueline. Let me know. Horrible mic. So I'm going to switch back to my old mic. Let me switch back to old mic. Is that better? Is that you prefer that one? Yeah, that one. All right, so then let's keep this mic. All righty, guys. Welcome back. Welcome to a recession. How does it feel being in a recession? Feels no different, right? Because actually the recession is a lagging indicator about something that's happened 2 quarters ago. So we're basically looking at the GDP for the last quarter. It's now negative 0.9, and before that we had negative 1.6 or 1.4. 2 quarters of negative GDP, well, should mean that we're in recession, even though Janet Yellen is denying it, the White House is denying it, Joe Biden is denying it, Powell's choosing to stay out of it. We're going to talk about the recession. We're going to talk about what this recession means, whether it can be a long recession or a short recession. And I've got an amazing guest on the show today. He's a macroeconomist. You may know him. His name is Alfonso. He's going to be joining us at some point during the show. Let me get rid of this other mic, which James bought for us. Yeah, by the way, James is not fired. He's still here. All right, we've got a lot to talk about today. So what I need you guys to do, smash up the like, subscribe to the channel. We need you guys to subscribe. I heard a shocking statistic yesterday. I heard that only 48% of people who are watching the show are actually subscribed. Can you believe that? That means that the others are just finding this content by chance. Hit the subscribe, hit the bell notification. That's how you're going to know that we're here. And this is the channel that brings you the most alpha on the internet. I don't care what anybody else tells you. This is the channel that brings you the most alpha on the internet. A lot of people talk, but we actually bring you alpha. All right, Macro Alf, that's the guy that's coming on. Also, a lot of you are asking, why are we here so early? We moved our time back. We moved our time back to 9:15 EST. You know why we moved our time back to be at 9:15 EST? Because we want to be first. We want to be the first people in the world that bring you the US news cycle. So here we are, 9:15 EST, bringing you crypto love and crypto wisdom. What I need you to do, smash up the like, because that's going to tell people that we're here and we started early. All right, let's do this. Let's talk about, no, I'm not delayed anymore. We've changed. The station's changed. I'm not delayed anymore. You don't see and you won't see any more clickbait tiles. You probably have seen that already. We've toned down our tiles. We will not be late again unless there's a real technical issue. We don't do that anymore. We're not going to speak about small cap projects unless we really believe in them. We want to make sure that our community is protected. Yes, we may have been aggressive in the bull market, but for now, we're going to change our way slightly, and we're going to, just be a little bit more respectable and a little bit more credible. So that's where we're at. We're going to be more like Kyle Dupes. More like Kyle Dupes. All right, let's talk about what's happening on the market. So yesterday, when Powell spoke, we pretty much saw exactly what happened when Powell spoke. Where are we now? Well, you got Bitcoin. Bitcoin doesn't care about the recession. Bitcoin's at 23,120, which is exactly where it was before the recession numbers came out. What we're seeing is a bounce off this trend line. We're seeing that we're now well clear of that 21,800. But if you zoom out, what you're seeing here is you're seeing that there's really no more resistance until about 28,000. And actually the first real resistance that we can expect is around 29,234. What do we need? We need Bitcoin to stay above this level for a couple of days. We probably want Bitcoin to break over that 24,241, which was the previous high. And then if we can break through there convincingly, then I think we're going up, and I think we're going up to 29,000 if we get there. So very, very, very positive. And I'm going to show you today why this was also positive. What happened in the markets that made this so positive? Let's take a look at Ethereum. Ethereum also looking very good, and the reason why I'm looking at Ethereum is because Ethereum for me is the proxy of altcoins. I also think I think the next couple of months are going to be all about Ethereum. I think Bitcoin's going to have to take a backseat. And the reason why Bitcoin's going to have to take a backseat is because of the merge that's coming. And while Ethereum has got this amazing thing, the merge coming and bringing in more institutional money, because now you've got a proof of stake chain, which is much more environmentally friendly, Bitcoin has the exact different overhang. Bitcoin still has the Mt. Gox coins, which are about to come onto the markets. Now, we know the Mt. Gox coins are starting to trickle into the market in August. So what you can expect from the next couple of months is you can expect the altcoins, and specifically Ethereum leading the altcoins, to rally much harder than Bitcoin, because it's almost like Bitcoin's got a cloud over its head. Every time we want to celebrate, it's got that cloud bringing it down, which is the Mt. Gox coins. So for now, I would be looking much more into altcoins. Unless something happens, I'd be looking much more into altcoins. And again, looking at Ethereum, we've now got the support level at about $1,480, which I guess we should try and stay above that, and then we can continue to go up into the next level of resistance. All right, we've also got the dollar index. So the dollar index, super important for us in terms of what's been happening over the last couple of days. Why? Because it's been on that trend. Now, what you can see is that it broke down on that trend, but it bounced straight back up. And now if you look at is, I think, just under that trend line. So it does look like the dollar index is breaking that trend line. And in context of what's going on, in context of Powell increasing interest rates yesterday by 0.75%, 75 basis points, we can expect the dollar to be going down. I'm going to show you why in a couple of secs. Also, US, this is a chart that you must be watching. And look at that chart now, since we heard that the US is going into recession. So look at this. It's the US 10-year Treasury yield, which is effectively the yield that people get for buying US 10-year Treasuries. What we want is we want that to be low, because that sets the expectations for interest rates. That means that it means that the market believes that Powell is probably done or close to done in terms of increasing his interest rates. And bang, you had that head and shoulders. There's the left shoulder, there's the head, there is the right shoulder. And now, really, as we started the show and the data was released, there's the break under the right shoulder. So I think that if we close there, we've completely got ourselves a head and shoulders pattern, and that could bring this line over here down to 2.2, 2.3%. So this is a brilliant chart. Most people won't show you this chart because they don't understand it, but it's actually the most important charts of all the charts. The most important chart that we're watching is this US 10-year Treasury yield, because it shows us, in context of what we saw yesterday, what the market thinks Powell's going to do. Let's look at how the stock markets are going. Stock markets also don't care. They don't care about the recession, which means that they believe that the recession was fully priced in. Everybody knew we were going to be in a recession. Remember, I said to you guys yesterday that there's two options. There's a small chance that we're not in recession, in which case the markets run. And there's a probably what the market's priced in is the fact that we're actually in a recession. And here we are in a recession, depending on of course, whose definition you go by with recessions. We're going to talk about that also in a couple of seconds. Alrighty, so that is where we're at. Those are the charts we're going to be looking at. Keep your eyes on this US 10-year Treasury yield rate. It's just broken the neckline. If this carries on, I think we've got a license to be risk on. I think this is a good chart to tell us that we've got a license to be risk on. All right, let's look at Powell. Let's talk about what he said and what he did yesterday and why everybody got so bullish when Powell spoke last night. Because if you listen to what Powell said last night, it started off very formally. Our mandate is to control inflation. We're going to do everything within our mandate to control inflation, talking about the unemployment, et cetera, et cetera. But there was also another underlying message. And if you listen carefully to what Powell said last night, what you also heard is that they finally caught up and that they're no longer behind the curve. Now, that is technical speak for saying we're no longer trying to catch up with the market. We now believe that our interest rates increases are in line with where we should be. Okay, now that's good for the Fed because the Fed was behind the curve. It was behind the story for a long time. And now, admitted by the Fed and admitted by a lot of analysts after it seems like the Fed has caught up to the market and I don't have any more catching up to do. And that's brilliant news. And I'll show you in a second why that's brilliant news. But let's go back and look at some of the things that Powell said and when he said them. And I was watching this last night and I was watching this on the 3-minute chart. And it was amazing to see the candles printing as Powell was speaking. Okay, so as Powell was speaking, the candles were printing. Look here. So this candle over here, see this big green candle over here, this one. This is at, should be my time, or actually we can look at your, hold on, how are we going to do this? Should we look at our time or their time?
Their time.
Okay, hold on a second. Let's go to here then. Let's go to about 8:30. So you can look at it here. Now watch this. This is what he said. This is the first thing that set the Bitcoin chart off.
So I guess I'd start by saying we've been saying we would move expeditiously to get to the range of neutral, and I think we've done that now. We're at 225 to 2.5, and that's right in the range of what we think is neutral. So the question is, how are we thinking about the path forward? So one thing that hasn't changed is that it won't change is that our focus is going to continue to be on using our tools to bring demand back into better blend.
Okay, so first thing is we're neutral. We're where we should be. We're not behind the curve anymore. That was brilliant. That set the markets off. That really set the markets rallying. Then he went on and he spoke about the next meeting. And listen to what he says about the next meeting. So this is where it gets super interesting. This is, again, caused a huge pump. Listen carefully.
Hi, Katarina Saraiva, Bloomberg News. I wanted to ask a little bit more about the 75 basis points versus 50 versus 25. Can you talk a little bit about what kind of goes into your thinking for making the decision on how much to raise rates, and just talking about a very large amount that you alluded to, could that possibly be 100 basis points? And then kind of along those lines, is there any sort of weakness in the economy outside of inflation measures that would lead you to slow your hiking pace?
So I'm gonna take that as a question about the next meeting and thereafter. So as I mentioned, we're going to be looking at all of those things: activity, labor market, inflation, and we're going to be thinking about our policy stance and where does it really need to be. And I also mentioned that as this process to slow down, and we haven't made a decision when that point is, but intuitively that makes sense, right? We've been front end loading.
Okay, so he said
very large rate.
He said that he's seen that the actions have actually started to slow down the economy, and that is what we're looking for. We want the Fed to know. We want to know that what the Fed is doing is actually going very well. The last thing that you should listen to probably is you should listen to what he said about recessions, because everybody was preempting the fact that we were getting into a recession, and now we're in that recession. Let me take you a little bit forward. I think it was 44, 45. There we go. Let's quickly go here.
And again, we pivoted, and here we are.
Nancy Marshall-Genzer with Marketplace. Chair Powell, I just want to pin you down a little bit more on the issue of recession. So if we get a negative GDP number tomorrow for the second quarter, would the Fed consider the US in a recession? And just remind us, what is your definition for the start of a recession?
What is the
Fed
definition of
doesn't
recession?
doesn't make a judgment on that. You know, we're focused on the dual mandate and using our tools to achieve maximum employment and price stability. We don't say there is now a recession, that kind of thing. So that wouldn't be something we do. We would look at the data tomorrow, and no doubt we'll look at it very carefully and draw whatever implications we can. As I mentioned, though, you know, if you think about what a recession really is, it's a broad-based decline across many industries that you know, that's sustained for more than a couple of months, and there are a bunch of specific tests in it, and it just doesn't seem like that now.
Everybody is dodging the question of recession. All right, so that is where we at. As I said to you, I think there were two stories that were happening last night. I think Mohammed Alarian came on to CNBC today. I was listening to him earlier. Listen to how he worded it. I think it was brilliant.
So what does it mean? Well, there were two FOMC messages yesterday. There was a scripted message, which was that inflation is much too high, that yes, the economy is weakening, but don't worry about it because the labor market is incredibly tight and we're going to continue tightening. And then there was that unscripted but consequential comment that we are at neutral. So depending on which FOMC message you look at, you get very different conclusions with today's data. I think the bottom line, Andrew, is we're not out of this stagflationary forces yet. Yes, inflation.
Okay, so the Fed is neutral. That's the big news. That's what set markets pumping. I'm saying that if we look at markets are still pumping. Yeah, Bitcoin, 23,265. Car must be burning. The NASDAQ up 12,615. So the market is celebrating that the Fed has actually caught up to the curve. That's where it is. Now let's look at where we're going in September. Right now in September, there's a 72% of a 50 basis point rate hike and a 28% of a 75 basis point rate hike. I actually think that this data, the data from all these rate hikes, has got to take time to get into the market. You know, you can't just raise interest rates by 75 basis points this time and 75 basis points last time and immediately gauge the impact. So I think what's going to happen now is you've got 8 weeks until the next FOMC meeting, because there's no FOMC meeting in August. In September, you've got another FOMC meeting. And I think what's going to happen is by that time, we're going to get two inflation readings, and the Fed is going to be able to make much more calculated decisions. And we also know that the commodities prices have started to come down. And so I think when they meet again in September, they're going to realize that the US is in a recession, that the inflation numbers have started to come down. And what they're going to actually do, I think by the time we get to September, we actually get into a situation where there's a third bar here, which is a 25 basis point bar. That's what I think is going to happen. Let's see if I'm right. If I'm not, I know you guys will cut this out and meme it and whatever else. I think Gareth agrees with me. He says, look, it looks like, you know, the dollar falling tells us that after today's 75 basis points rate hike, he says September 25 basis points, and I think it's done. I think he's 100% right. So that's where we're at. That was Powell. That's why Powell sent the markets running. You know, the markets running yesterday was actually also very, very, very good for Facebook. So Facebook managed to hide its bad earnings under this Powell speech. So we first had Powell speaking, and everybody was talking about interest rates and the increase in interest rates. And only then did Facebook publish their numbers, and their numbers were bad. I mean, they had the first time I think that they've had a miss in, Charlie Biella says the first time they've had a miss, I think, ever since first time revenues fell 1% over the last year for the first negative year-on-year growth in the company's history. Can you believe that? In the company's history. Probably another thing which you should look at here is the fact that they are investing a lot in the metaverse company. So they've got this company which is around building the augmented reality and virtual reality for the metaverse. This company is called Reality Labs. Now, Reality Labs has lost $5.7 billion so far this year. $5.7 billion. And in total, it's lost about $16 billion. Can you imagine that Zuckerberg has invested $16 billion into the metaverse, and right now he probably doesn't have much to show for it. Like, it looks like it's quite dismal, but he's keeping a long-term view. And I think we should be quite thankful that he's here, because he is promoting the metaverse, and the metaverse is going to be driven by NFTs. He says, look, you know, we are spending a lot of money, but developing metaverse platforms will unlock hundreds of billions of dollars, if not trillions, over time. So he's taking a much longer view. we've got to remember that today is also a big day. We haven't finished with the earnings. Today is also a massive day. In fact, I think I would say today is one of the biggest days when it comes to earnings. You've got Apple, you've got Amazon, and you've got MasterCard. So Apple, Amazon, and MasterCard are all today. The reason why I think that that's so big, well, Apple just because it's Apple. MasterCard because MasterCard, after Visa outperformed, we need to see how MasterCard did because that really measures consumer sentiment. And then you've got Amazon. And Amazon, after the Walmart warning earlier this week, I think all eyes are going to be on Amazon. If Amazon misses or Apple miss today, I think we could get some kind of cool down in the market. And again, the reason why I say we can get some kind of cool down in the market is because if we look at where we've come from, I mean, let's look at the last couple of days. The Nasdaq's had an amazing run in the last couple of days. If you look at it from 13th or 14th of July, you've had a run where you've got it up 10%, which is huge. So Nasdaq up 10%. I think if Amazon missed, just watch out. If you see Amazon missing, then watch your crypto positions, watch your Nasdaq positions. All right, let's now talk about the big news of the day. And I think the big news of the day must be the fact that the US reported negative 0.9% growth in GDP for the last quarter. That's the second quarter in a row that they've reported negative GDP earnings. Now, question, is the US actually in a recession? Depends who you ask. I guess the answer is depends who you ask. I'll tell you why the answer is depends who you ask. Because if you ask the White House, I mean, if you ask Google, then you see that it's quite clear that it says here, as per the Oxford Dictionary, it says a period of temporary economic decline during which trade and industrial activity as measured by GDP are reduced generally identified by falling GDP for 2 successive quarters. We've now had that. But the White House still doesn't agree. The White House still says, I mean, listen to this.
Where we are today.
If things are going so great, though, then why is it the White House officials are trying to redefine recession?
No, we're not redefining recession.
If we all understand a recession to be 2 consecutive quarters of negative GDP growth in a row, and then you have White House officials come up here to say, no, that's not what a recession is. It's something else. How is that not redefining recession?
Because that's not the definition. That is not the definition.
Brian Deese said in 2008, of course, economists have a technical definition, which is of a recession, which is 2 consecutive quarters of negative growth.
I can tell you this.
Yesterday he said 2 negative quarters of GDP growth is not the technical definition of a recession.
It is not. It is not.
Why did he say that?
It is not. I can speak to what he said yesterday in front of all of you, which is the last thing that you just repeated. There are many factors. Economic factors and indicators to consider, and I will say that the textbook definition of recession is not 2 negative quarters of GDP. We have a strong labor market.
The textbook definition of a recession is 2 successive quarters of negative GDP. Word it how you want. Janet Yellen also saying, I mean, this is how she responded. We did play it earlier in the week.
Let me just start with this. Many businesses seem to be preparing for a recession. Should all Americans at home be preparing for what's for a recession that many people think now is likely?
Well, look, the economy is slowing down. Last year, it grew very rapidly at about 5.5%, and that succeeded in putting people back to work who had lost their jobs during the pandemic. The labor market is now extremely strong. Even just during the last 3 months, net job gains averaged 375,000. This is not an economy that's in recession, but we're in a period of transition in which...
Period of transition. Remember the last time that the White House and the Fed used the word transitory or period of transition? Remember how that worked? Remember how that worked out? Look, now I'm super confused. I don't know what the definition of a recession is. I studied a CFA. I went to college, and every textbook that I ever read said the recession is 2 successive quarters of negative GDP growth. Now, we've had 2 successive quarters of GDP growth, and the government is telling me that we're not in a recession. And they're referring to some definition around labor. So I'm super confused. Usually when I'm confused, what I do is I get the best people in the world to come in and help me walk through this. And that's why today I've got a great guest for you. I've got Macro Alf for you. Macro Alf, how are you, sir?
Hey, I'm good. Thanks for having me.
I'm so confused, man. I need your help. What is the definition of a recession?
The definition of a recession is 2 consecutive quarters of negative GDP growth. And then if we really want to be honest, it needs to become practical. So a recession is a period in which people lose their jobs. That is also true. You don't have a proper recession unless the labor market is getting hit and the real economy gets a bigger hit because people are out of their jobs. And so that's basically where the White House and Powell as well are trying to hide. But the problem is that the labor market is a slightly lagging indicator. In macroeconomy, Rand, there are 3 types of indicators: forward-looking indicators, coincident indicators, lagging indicators. All the forward-looking indicators are looking as bad as they can ever look right now, and they're worsening at every print. The coincident indicators, say the labor market is coincident to slightly lagging. Of course, it's going to take a while more until it weakens to the point that it confirms what the GDP is telling us, but it will definitely do so. It's just a matter of time. Every week, we got a new large company telling us there is either a hiring freeze or they're outright laying off people. Jobless claims, the most forward-looking indicators amongst the labor market indicators. Moving average up, up, up. We just had another print, 255,000. Again, it's printing up, up, and up. What's telling us is that in 3 to 4 months, the Fed won't be able to hide behind this strong labor market as well anymore. But as long as they can hide, they will.
First of all, I think let's talk about, I think I agree with you that we are in a recession. How scary is a recession? I mean, first of all, I think my data shows that in recent recessions, and I talk about the last 5 recessions, average recession between 4 months and 12 months. Do we agree on the length of a recession?
Okay, so I run an analysis on the Macro Compass on my newsletter. People can check it out. It's free. I looked at the last 100 years of recessions in the US. Just let's take a long history, right? Let's assess that. There's nothing to be happy about a recession. The average drop in GDP is pretty large. A lot of people lose their jobs, but a recession was always able to lower inflation down by a meaningful amount, and it always took minimum 16 months. So the average recession over the last 100 years has managed to bring inflation down by 7 percentage points from peak to trough in 16 months. We are now at 9%. To go all the way down to 2%, an average recession over the last 100 years actually managed to achieve that. So maybe it's not what we want. Maybe the Fed wants the soft landing they hope for. Very unlikely they're going to get one. If they get a recession, at least the silver lining is that probably history tells us we're going to be able to bring inflation back to.
What's more important? I mean, is it more important to bring inflation down, or is it more important to keep an economy stimulated and to keep markets running? I mean, I know the Fed has a mandate. The Fed's mandate is they're looking at it very single-mindedly. We need to look at inflation. What's more important? Like, should we worry about markets or should we get inflation down?
I think because of the design of our monetary system, it is the incentive of policymakers to bring inflation under control back again. How does this work? Very simple. In our monetary system, after 1971, we can just create new credit, new money out of nothing. There is nothing that pins new money creation to anything. They can just credit your bank account, the bank makes a loan, bam, you have money you didn't have before. Whoop, created. Now, obviously, it's really how it works. It's mesmerizing. I worked inside a large bank for 7 years. I run a large portfolio, so I'm very much into these weeds. And that's what happens. But to make sure that this system, which is so elastic, actually keeps itself in certain boundaries, you cannot have people expecting inflation to be 10% next year, or 12%, and then 15%, because there is no anchor anymore around the creation of new debt if inflation expectation go through the roof. And that is why policymakers are so attentive to keep inflation and inflation expectation within some controllable bands. Otherwise, this fully elastic system goes out of control. So it is paramount important, I think, for them to bring inflation down.
So if you were sitting in Powell's shoes, would you do what Powell is doing? I mean, I guess we can say, they shouldn't have been so behind the curve. Okay, but they found themselves behind the curve. That's just the reality of where they found themselves. They raised by 75 basis points in June and 75 basis points again coming up now. What would you do if you were sitting in Powell's shoes?
I would be forced to have to keep the foot on the gas pedal. There is no alternative. I mean, if you are him right now, he has basically two mandates: labor market and inflation. But this labor market, he can basically say, well, it's doing pretty well, right? But the other mandate is completely out of control. It's just literally out of control. And the history says as well, Rand, that this story that by hiking rates to mildly restrictive territory, it's more than enough to bring inflation down. Honestly, it's a fairy tale. If you look at history, every time you had inflation so much out of control, you had to jack up rates much higher than the level of neutral. So everybody's now feasting on this. Hey, the Fed is at neutral. They're going to slow down now because any new hike becomes restrictive. Of course, they need to be restrictive. Inflation is at 9%. Of course, they're going to have to be restrictive. So he has no alternative. He'll have to keep pushing until he actually achieves some results.
Okay, with that in mind, do you think that we've had the increase in June? We had an increase again last night for July. Now there's no FOMC meeting for 8 weeks. So there's no August meeting. Then in September, there's at the end of the month. We get two inflation prints in between that. We get one for July, which comes out in August. Then we get a September reading, which is for August. Commodity prices are down. What do you think happens in September based on all of this?
I think the base case you have to assume is that September is 50 basis point. But again, Ran, I mean, what you have to understand right now is that the slowdown in inflation, we hope it all happens. I mean, how long is CPI going to be able to print at 9 and then 10 and then 11%? I mean, are we turning into Turkey? So hopefully it goes down into more reasonable levels. But what matters is the pace of the slowdown. The Fed has incorporated in their own estimates that inflation is going to be at 3 to 4% at year end. For inflation to be at 3 to 4% at year end, month-to-month inflation needs to slow down at 0.1, 0.2. Like it needs to slow down very aggressively. So next time you see an inflation print, do not obsess on was it 8% year on year or 7%. Look at the month-on-month changes because they're looking at the momentum slowdown. That's what they want. And I don't think they're going to be able to engineer such a momentum slowdown in inflation that allows them to hike only 25 basis points, showing a straight face to market saying, inflation is coming down. We feel confident we're going to do only 25 basis points. I don't think it's a palatable strategy.
Let's talk about the contributors to inflation and then break them down one by one. So the first contributor to inflation is energy/oil. Okay, now we know the oil prices are down. Oil's gone from $130 a barrel. It's now back at, I don't know, probably let's quickly just get a chart, but I think it's probably around 100 a barrel or 104. I haven't looked at it today. Hold on, let's look at the Brent crude oil cash price. Okay, so oil is at $102. If we look at the balance of commodities, so I'm going to use the GSCI, which is the Goldman Sachs commodities index. You can see that there's been a massive drop in the commodities index. In fact, you have commodities down 16, 17%. That should filter into prices. The last big contributor to inflation is shelter. And I think that we may be starting to see a little bit of a move in the shelter market, the housing market. Where are we when it comes to that?
So the rent of shelter accounts for about 40% of core CPI. It's really large. You need to make sure that this comes down, right? Now, the problem with shelter is the following. Rent of shelter is probably the most sticky and the most lagging part of the CPI basket. And why? Because house prices tend to increase. It takes a while to transmit these mortgage rates into house prices. They do. Mortgage rates very low. A lot of people can borrow a lot of money. They buy more expensive houses. And then house prices go up. And then as a result, also rents start to go up. But it all happens with a lag, right? And the lag is very long. We're talking about 12 to 18, 24 months. So to see rent of shelter going down, you have two ways. You got to wait. In any case, you got to wait. I mean, it's very difficult to make this feed through immediately next month already. You got to wait. There is no way around that.
What's the wait? 6 to 12 months? I mean, is it logical for the real estate market to take 6 to 12 months to reflect reality?
It is one of the most interesting. It is one of the most leveraged markets in the world. The real estate market is the largest market cap asset class in the entire world. It's larger than the bond and the equity market combined. But because of let's say, the time that takes to actually get a mortgage approved, the buyers, who mostly happen to be households, consumers, they tend to make things generally a little bit slower than you would be able to lift Bitcoin or equities or bonds in secondary financial markets, right? There is a process behind it. It normally takes a little bit longer to feed through. It takes generally 6 months to feed through in house prices, and then it takes another 6 to 12 months to feed through rents. So generally speaking, the lag is 12 to 18 months rent. But what I see right now is that mortgage rates have gone through the roof. So Americans cannot afford these houses anymore. House prices are very high. Look at this chart. The affordability is the worst since the great financial crisis. It's a combination of high mortgage rates from 3 to 6%, and house prices went up by 20% on top of it. So people can't just afford their mortgage installments anymore. They pare back on buying houses. So prices need to be cut over time. But again, it takes a while to feed in there. But 6 months and then another 12 months to feed down rents. So if you're waiting for rents to bring down inflation, you got to be a bit patient. What you mentioned before, though, is extremely on point, which is commodities. Both the energy side, the food side, and overall the industrial commodity spaces, they're taking quite a hit. They're much more responsive to market forces than rent of shelter is. So that part of the inflationary basket will come down. But is it going to be enough to push the entire inflation down month on month to levels that will make the Fed feel extremely comfortable? Honestly, this is the biggest inflation fight the Federal Reserve has engaged in over 35 years.
I mean, I guess the last one was in the 1980s when Paul Volcker engaged in a recession. It was 79 and 80, right?
And that is correct. So if you were them with such an important credibility fight you're trying to actually win, would you just feel relaxed? I wouldn't feel relaxed. I would want to see actual progress. And so far, there has been no actual progress whatsoever.
Okay, fair enough. I think I agree with you now that we're probably more likely to see 50 basis points in September. I was inclined to say maybe we'll get 25% to 25 basis points, but I think I'm more inclined to do it. I mean, I hate saying this on a crypto show, but I guess the worst place to be in a recession is in a highly speculative asset, right? Is that, I mean, I don't like to be the bear that calls out the elephant in the room, but I mean, that's the rules of recession, isn't it?
So, Ran, look, I am a broad macro guy. I ran a $20 billion portfolio until 7 months ago. I did all asset classes. And what I learned in markets is the following. You cannot have this big ego in anything. You need to be flexible, nimble. Markets are going to humble you the whole time. The same goes with Bitcoin or any other asset class, actually. There is a moment to be long, a moment to be short, and a moment to go fishing, said my mentor. The first time I met him, he said, Alf, you don't need to have a position the whole time. You need to assess the risk reward and then decide where to go. And right now, you're totally right, Ren. This is one of the environments where you need to be more defensive. You need to be more conservative. There'll be a time where we'll need to lift all the speculative assets out there, all the risk sentiment driven assets. I don't think that is the moment right now.
I mean, I hear you, and I think I agree with you on a macro level, but I think in crypto, we may have had a anomalous, I think Luna was a huge leverage play, which knocked out all the lenders, which knocked out a lot of the funds, et cetera, et cetera. To me, that felt like a black swan. And I think I probably would have agreed with you to say, I don't want to be in speculative assets in a recession. But there is the other side of the coin which says, hold on, maybe speculative assets were a little bit, or this specific asset class was a little bit oversold because they just had their great deleveraging or unleveraging moment. What do you think of that?
That is a very valid point. So I remember doing an interview with Kitco, I think it was, somewhere in February. And they asked me, Alf, what do you make of Bitcoin? And I think we were at 50K back then, so 45, 50K.
You said 26.
I said 26. And David looked at me like, are you crazy? I'm like, no. I'm just analyzing the asset class and looking at the standard deviation, looking at the volatility of the asset class, looking at the leverage in there, and assuming we can see such a drawdown. And he was like, this guy's nuts. Bam, 26K, then 20K, then 19K. But then you're right. At some point on my models, it got oversold. Because of this deleveraging process, Rand, that works in every asset class, you're going to see the same everywhere. The world is so financialized and the creation of leverage is so easy and accessible that we are going to be incentivized to actually make use of this leverage. Because when volatility is very low, leverage amplifies your returns and you feel great because you're delivering big returns with very little volatility. And then all of a sudden you have these volatility clusters and boom, you have to deleverage. Everything goes down and goes down much more than what the fundamentals effectively would justify. I think part of that has happened with Bitcoin, but I am a broad macro person. I tend to look at asset classes over 3 to 6 months horizon. Right now, I tend to be still a bit defensive on the asset class.
Okay, so you're defensive. You're not buying crypto. What I also know though is that usually markets recover before recessions end. So we ran a little bit of an analysis yesterday. It's not as deep as any of your analyses, but we looked at recessions and when the market started to recover relative to when the recession technically ended. And we kind of found that markets started to recover about halfway into the recession. So there was no exact science because every recession is different. But what we found that markets started to recover halfway into the recession. Do you think that that's a good, or maybe let me ask you the question, when do you think it would be a good time? What are the indicators that would tell us it's a good time to start accumulating, and specifically risk assets?
Ryan, the analysis is spot on, by the way. You're too humble, but I think you did a good analysis, and we can explain why that happens. When you are in the midst of the recession, exactly in the middle, if you look at the returns, let's say from the stock market, you have two sources, earnings and valuations. Those are the two sources of returns in the stock market, at least the most important, right? When you are in the midst of the recession, what has happened already is that all analysts have revised down their earnings estimate big times because you are seeing this recession unfold in your eyes, in front of your eyes, and then you're going to lower your earnings per share estimate. So that drawdown already happened. Most of it already happened. When it comes to valuation, well, everybody's like, whoa. We are in a recession. I need to be risk averse. I'm not going to buy anything. I'm going to just stand back. There is no capital flow into markets, and then therefore valuation cannot expand. They tend to contract. So the two biggest drivers of returns actually have been decimated. Exactly at that point, you are about to bottom when it comes to the growth slowdown. So you're about to reaccelerate a little bit and to surprise on the upside in earnings. And on top of it, most likely you have done enough damage to the economy, enough damage to inflation, that the central bank can also say, maybe now we should do roundabout something here, right? They start ease, they start doing QE, and so valuation can go up again. And it is exactly at that point when everybody seems to have given up basically on earnings and on valuations, that you have these fantastic generational opportunities to start accumulating assets. Are we there yet? I don't think so.
I think we've just tapped the surface of what's about to come. I don't know, that's the way it feels when I look at the NASDAQ. Maybe not crypto. I must say again, I still think that on crypto we may have had more of a deleveraging, which I think the stock markets have yet to do. So that's what I think. What are the indicators? What do we look for? What do we look for when we're looking to reinvest? Like, what should I look for? When should I phone you again? I know I phone my chartists. They give me a trend line. When we break the chart, when the chart breaks the trend, I phone them. I say, look, is it safe to go in? When do I phone Alf again to say, look, Alf, is it time for me to invest? What am I looking at?
So you're looking at capitulation from analysts. If you go and ask Wall Street analysts right now, of course, they're talking their book, they need to sell, so they're always going to say everything is fine. Earnings consensus from Wall Street analysts, earnings in the S&P 500 companies plus 10% this year. Can you please tell me how companies will be able to deliver a 10% earnings growth this year and 9% next year? Give me a break. I mean, we are not going to be able to achieve that. When you see them throwing the towel in, Ren, when you see them saying, sell advice on that company, sell advice on Amazon, sell advice on Google, sell advice on that, then you can give me a call, because we are getting closer to the point where people have given up.
Okay, I mean, I hear you. I do want to say, though, that what has surprised me over the last week, we had the biggest earnings week of the year. I think today tops it off. In a couple of hours, we're going to get Apple and we're going to get Amazon. To me, those are the two pivotal ones. Yes. Okay, but Google, underperform. Microsoft, underperform. Facebook, underperform. Market up 10%. What am I missing here?
Yeah, what you're missing is that the market, basically, the bond market has made up its mind very, very strongly on the fact that inflation is going to come down super, super fast. I just pushed an article on the Macro Compass. It's a deep analysis of the Federal Reserve meeting yesterday, and it explains why the market rallied so much. Basically, the bond market is telling us inflation is going to collapse. That's what they've priced in. And
10-year or 2-year? Which one are you looking at? 10-year or 2-year?
I'm looking at short-term inflation expectation.
Short-term. Okay.
Yeah, so basically, I calculated what is the inflation expectation between summer 23 and summer 24. And between summer 23 and summer 24, it's a bunch of derivatives. I don't think you're going to be able to find it on TradingView, but you can find a proxy with 2-year inflation swaps. Yeah,
there we go.
Yeah. So what you can see is that the market is basically pricing in inflation to slow down very aggressively, super fast. And yesterday, Powell told us we're going to be data dependent, guys. We're not going to just push on the accelerator. And what happens back then is that if you are the market and you have this strong opinion that inflation is going to slow down and the Fed says we're going to be data dependent, and then they're going to do 25 in September. Then in December, they're going to do 0. Then they're going to cut some rates next year. And if the Federal Reserve becomes more accommodative, then valuations expand. And all these companies you mentioned, Amazon, Facebook, Google, look at their valuation. They are so valuation intensive. They're tech companies. They need valuations to expand. And, you know, if Powell even hints that it's going to slow down, it's going to be data dependent, and the market is so convinced inflation is going to slow down, these companies actually can make money.
Yeah, I agree. Is there any way to hide? I mean, is there anything that we can be investing in a recession where we could get some returns? Because it feels like stocks are a no-go zone. It feels like property is a no-go zone. It feels like crypto, from what you're saying, is a definite no-go zone. I mean, are you saying that the only place to hide is government bonds? Is that where we're at?
Again, Ran, my friend, what I learned is sometimes you just gotta hide a little bit. And, you know, there are cycles and you gotta risk manage a little bit, you know. And I'm not saying don't have any stocks or don't have any crypto, because maybe your time horizon is long enough that you can afford this volatility. But watch out, because in these periods, volatility can be very high. So what I have basically, what I am doing for my own portfolio, on the Macro Compass already in November, I said, guys, just raise some cash. And I know it doesn't sound fancy, but just sell all the high speculative stuff and raise some cash. And later on, I think when 30-year treasuries went to 3.30% or 3.25%, I started buying some 10-year treasuries, 30-year treasuries. And why? If the Fed is going to fight inflation all the way, Ran, and is going to keep hiking rates and it's going to be so tight, they're just going to hike us into a recession, and they're going to make it worse. They're going to make it long. They're going to make it deep. Because remember, they want inflation to come down in the end, and they're going to make us go through some pain. Once you make us go through some pain, what happens is that 10-year bonds, 30-year bonds, they start becoming good investments, because, you know, rates then, you have to keep them very low for very long to allow for a recovery. If you were able to buy these bonds at 3%, at least you made some money in the meantime. It's not the most fancy thing, but remember, there are cycles to be aggressive, cycles to be defensive.
You know what I think we need to do? I think we need to convince Binance to list 10-year bonds and 2-year bonds. You know, that's the only way we're going to get our crypto. The only way I'm going to get this crypto community to invest in bonds is if we can get a listing. But then can you imagine the spike in the bond price when it gets listed on Binance? Can you imagine the 10-year yield spike because they're listed on Binance? All right, listen, Alf, it's been absolutely golden alpha to get you guys. If you want to follow Alf on Twitter, I think you should, at Macro Alf. And if you want his free newsletter, which I think goes to 75,000 people around the world, absolutely free. All you do is you click on that link over there, and then you effectively go and register for the newsletter. Alf, my man, it's been absolutely amazing. I can't thank you enough. Thank you, my friend. Thank you, thank you, thank you.
Ran, every time you want me back, give me a ring and I'll be here. Ciao, guys.
Definitely. Ciao, ciao, my friend. All right, you heard it from the number one guy in the world. You heard it from the number one guy in the world. Follow the guy. Give him some love. Give him that banter love. Speaking of banter love, let me know what you think of the show earlier. And the reason, again, why we did this, I like that, alpha. The reason why we did this is because we wanted to be first. We were always the first, and now we want to keep being the first. We want to give you the news as it happens, when it happens. And so when the US people wake up and there's a news cycle, we're going to be the first. That's why we did it for you guys. I guess we've got a few more minutes. Let's talk about one or two more things that I did see, which are probably worth looking at. I think we've all seen the Solana concept store, which is now opening in New York City, showcasing NFTs, and I think one day we'll showcase the phone and Solana gear. I think a great PR and marketing stunt. This is something I think we should talk about, and this is Ethereum active addresses making an all-time high in the bear market. How's that? So Ethereum active addresses making an all-time high in a bear market. Over 1.1 million addresses made an Ethereum transaction yesterday, making a total of 1.64 million Ethereum transactions. Can you believe it? It's basically destroyed the number of transactions on Bitcoin. Also, remember we DCA'd yesterday. So I mean, let's not talk about our portfolio one day into it, but just wanted to show you that it's now all updated. On CoinStats, both exchanges are now updated. We hold about $1,000 worth of tokens. We got about $1,000 worth of cash, which, by the way, I'm going to invest on Monday because tomorrow we have a big show. You know what day it is tomorrow. Tomorrow is Banter. Do we have the Banter tile up? We should have the Banter tile up. So let's get the Banter tile up so we can show the guys who's coming on. If I remember correctly, it's Dan Tapiero, Scaramouche, and there was Mark Yusko. Now remember, Banter remains at the old time just until we can change all the guest times going forward. So Banter starts tomorrow at 10 a.m. EST, 10:15 a.m. EST, not 9 EST. Also, lastly, I have some really good news for you guys. Really good news. Starting somewhere around September, and I'll give you guys a date. We are going to be hosting a Crypto Banter trading competition on BYBIT. So remember like the World Series of Trading that BYBIT ran for their own people? Well, we're going to do one just for Banter people. So everybody's going to be able to participate, whether they sign up with a BYBIT link or not. But the winners can only win if they signed up with a Crypto Banter link. And we're going to do weekly winners. So once a week, weekly winners, and have some fun with you guys. All right. Listen, I've had a lot of fun today. Maybe we've gone a little bit over. Maybe Fred's going to shout at me later. I don't care. Fred always shouts at me. You know, there's another one. Okay, so yeah, here we go. Yeah, here is the tile. Yeah, it's happening. There's another song that Fred doesn't let me play, but I think we should play it. I mean, what the hell?
Smash those likes, give it some love. Smash those likes, yeah. Smash those likes, give it some love. Smash those likes, yeah. Smash those likes, give it some love. Smash those likes, yeah. Smash those likes, give it some love. Smash those likes, yeah.
Alrighty, guys. I'll see you guys again tomorrow. Until then, have fun, trade well. See you tomorrow. Remember, it's the old time, 10:15 a.m. EST. Monday, back to 9:15 a.m. EST. See you guys again tomorrow. Carl, you got a special one for winter, bro, like an effect for crypto winter.
For the short that I took.
Wow.
Which is only in profit, by the way.
Oh, did you actually took a trade?
Yes, I took.
Whoa, everybody stop.
Should go live again.
Carl took his first trade.
That's not the first trade.
Did you actually did you get into the trade?
Yes, I did it live.
You did a live trade?
Yeah, I did.
My goodness. My goodness. All right, well, Carl, well done for taking your first trade.
The community appreciates your exit liquidity when you were long.
Oh, thank you. All right, love you guys madly. Bye.